Treasury Secretary Scott Bessent speaking with Maria Bartiromo earlier this morning. Here's what he had to say. First, on China, he says aircraft engines, certain chemicals and the IPO market could be leverage in China talks. On the economy, he says he's less concerned about a recession. He believes we will see a substantial drop in inflation. And he says the Fed has been too high for too long. On AI, he says they're working on a plan for jobs replaced by artificial intelligence. All right? Now listen to what he said about what would happen if Zoran Mandami brings up his socialist policies, brings them to New York. Watch.
I guarantee you, and there are not a lot of things in life that are sure, that New York City will be coming to the federal government for a bailout if the Mandami plans are implemented.
And are you going to give him that bailout?
It will be the same thing that Gerald Ford said. Drop dead.
Whoa. I remember that, actually. It was a headline in the local
Daily News.
Yeah, in the Daily News. Ford to New York, drop dead.
Right.
Bessent would say the same thing to Mandami. Good stuff, strong stuff. You're an economist, Anthony Chan. Treasury Secretary Bessent just said he expects a sharp drop in inflation. What do you say to that?
Eventually, Stuart, that's going to happen because
Yeah,
the Federal
he didn't give a time
Reserve
frame.
policy is restrictive right now, so eventually it will happen. But keep in mind, Stuart, it's been 4.5 years that the Federal Reserve has not been able to keep that 2% inflation target. Inflation has been running above the 2% for 4.5 years. So it's a big endeavor.
I'm reading between his lines there. He seems to suggest that AI will make a significant contribution to the economy, and part of that contribution will be less inflation.
There's no doubt that that's going to happen, but it hasn't happened yet, Stuart.
Okay, understood. But for the rest of this year, what's your inflation forecast?
I am looking for this year to give you, say, the PCE, the core PCE, somewhere in the neighborhood of 3 to 3.2%. Why?
Wait, hold on. 3 to 3.2 or 3 to 2.2?
No, 3 to 3.2%. It's not going to go down between now and the end of the year. The Federal Reserve believes it's going to take 2 more years to do it. I believe it might take less time, but it's certainly not going to happen yet because, again, all this stuff is going through the economy, the tariffs and things like that. Right. What happens when you impose a tariff? The good news is the administration says, eat the tariffs for the companies. Look at the tariffs on coffee, 50% tariffs on Brazilian coffee. And yet the Consumer Price Index says coffee prices are only rising 20% year over year. Will consumers react? I don't think so because the labor market is weak. Non-farm payrolls are growing at 29,000 over a 3-month period. Keep in mind that last year, Stuart, we saw in the spring that non-farm payrolls were growing at a 3-month average of 200,000, and later in the year went down to 116,000. So with this weakness, consumers are not going to be brave enough to ask for higher wages. So that can dampen the potential spread into wages.
You're looking at an inflation rate, PCE, price, core consumption, etc., 3.2%.
Yes.
If you're right, that would surely stop the Federal Reserve from lowering interest rates again.
I don't think so, and I'll tell you why, Stuart. Because the weakness in the labor market is serious. Right now, I don't think consumers mind that coffee prices are up 20%. They would mind more if they didn't have a job. The unemployment rate went up to 4.3%. Now, I just did some research on a Substack article that I just put out right after the Fed lowered rates, and guess what? The average unemployment rate during a recession, 6.2%. We're at 4.3, so we're lower. The range, 4.8 to 9%. But again, it's moving in the wrong direction. It's moving higher. So I think the Federal Reserve will continue to lower interest rates.
Okay, the economy is slowing a little.
A little.
Especially the labor market.
Yes.
Anthony Chan, thanks for being with us. Appreciate it. Thank you.